going to explain chapter 3, an important chapter in business studies. It will help you to know a lot of important concepts that examiners usually ask about. This is the syllabus that we have. This chapter will cover 4 main points in the syllabus. The first one, which is enterprise and entrepreneurship. We'll talk about entrepreneurs, their characteristics, and why they should have a business plan. And we'll talk then about the ways of measuring the business size. And also we'll talk about the growth of businesses and why businesses remain small. And we'll talk about the different ways in which businesses can use to grow. And of course the problems that they might face. And at the end we'll talk about the reasons of business failure. If it comes to the exam now, when it comes to the exam, the main points that I saw in past papers are the meaning. They ask you about the meaning of entrepreneurs and their characteristics. This is probably will be part B and C in paper 1. They have these questions, and business size is important. And what's important in business size is the limitations. They ask about the limitations. We'll talk about it in a while. Okay, so just this for now. Let's start. If you look at these people, probably most of you they know these guys. This guy here is called Mark Zuckerberg. He's the owner of Facebook. Now, of course, you know Facebook. Richard Branson is the owner of Virgin. Virgin Group, it's a group of companies. It includes airlines, mobile phones, train services, and a lot more. The third one is called Steve Wozniak. He's an American guy who owns an Apple Computers. He's a billionaire. And the fourth one is me. Yes, I'm not an entrepreneur, but I'm planning to be one of them. I hope one day I'll be one of these guys. So I don't know if I'll be one. Hopefully I will. So if you look at these guys, you see that these people had a lot of ideas, and they started their own business with an idea, and they took a lot of financial risks to start and manage their business. So if you are an entrepreneur, you are simply a person or an individual who has an idea, and you take a financial risk to start up your own business. So of course you should take risks to start up your own business and implement the idea you have. Now of course not everyone will be an entrepreneur, so these people have similar characteristics. So first, they are initiative. They are able to develop a good plan and achieve their objectives. They are risk takers, of course. They are prepared to take risk, and they always see the failure as a very good experience and a positive one. And the last one I mentioned here is self-confidence, which is important to have. It's having a strong belief in your own ability as an entrepreneur and ideas, of course. Without self-confidence, probably entrepreneurs cannot talk to other people, because they need to convince banks, for example, lenders or customers to buy their goods. So they should be self-confident. We have many more characteristics. We have characteristics like hardworking, optimistic, creative, risk takers, as I said, effective communicators, independent, for example. But I just listed these. It's not. It's enough to know 3 of them, because in the exam they will ask you about 2 or 3 of them, not all of them. Okay. So here the benefits of being an entrepreneur. Of course, if you are an entrepreneur, that means you are independent and you will be able to put your own ideas into practice. Your business might be famous and successful, and you will make a lot of money instead of being an employee. However, a lot of disadvantages are there. The first one is risk. A lot of new entrepreneurs fail because of several reasons. We'll talk about it at the end of this chapter. one of the main reasons is poor planning, which is the main thing in being an entrepreneur. A good plan will make your business successful. A lot of people, they lack money. A lot of them, they have no knowledge or bad experience when they start their own business, so probably they will fail. Now, when I talk about business plan or entrepreneurs, these are totally related. So if you are an entrepreneur, you should have a business plan. A business plan is just a document. It's a written one that outlines all the purposes and aims of the business. So it's mainly used to persuade, to convince lenders like banks and of course investors who are willing to invest in your company. The business plan will convince them. So if you are an entrepreneur and have a great idea, you should have your own plan and make a plan. If you don't have a plan, then you should create your business plan, and if it makes sense, then yes, you are on the way to be successful. However, if you don't have a plan or it doesn't make sense, you should go back, draw your business plan, and continue or do your business. So business plan is very important because it helps entrepreneurs in many ways. As I said, business plan is the main thing for entrepreneurs. The banks probably will ask entrepreneurs for a business plan before giving a loan or giving help to finance the new business. This is the main target of business plan. The second one will be in the business plan, what are the products that I'm going to sell? What are the services should I provide, and to which customers or to which consumers, because I should know them. The third one will be what will be the main cost, and of course you have cost, but you should know also is it enough for you to sell your products at a certain price and pay the cost back. Sometimes you fail if you don't plan this. Where will the firm will be located? Of course, this is very important. Location is an important thing for businesses, and we will study this in details in chapter 18. Also, there is an important thing, which is the machinery. The money will be spent to buy machines and to hire people. So I should know the number of people, their skills, the machines I need, and many more. In business plan, usually they are 60-70 pages. So they include all the details. Everything you can imagine about the business is there. So the main target, as I said, is to make a business plan to get a loan. So if your business plan is poor, probably you will get no bank loan. It's very simple. If you visit any bank and ask the bank manager for a loan, and the bank manager believes that your business plan is not well completed, for example, you don't have a forecasted cash flow, or you don't have a forecasted sales, or you don't know what will happen after the first year of operation, so probably the bank will not give you a bank loan. So I cannot finance my business without money, because most of the business owners, they go to banks to get their loans, of course, as a beginning. This is for business plan. Now, when I say new businesses, I mean we call them in business startups. These are the newly formed businesses. All businesses, they started small. I remember I read about the owner of Dunkin' Donuts, and I read his story. He started a very small place in the States. It was very small, and his target was to sell coffee and donuts for people. But nowadays his business is very well known, and of course it's all over the world. So usually when you start your own business, the governments will encourage these businesses to start for several reasons, and the government know that these businesses will benefit the economy, and they will have a lot of advantages. Job creation is the first one. Of course, they will create jobs, and they will have new ideas. So new ideas will bring in new goods and new services, and this is good because the choices for consumers will be more. The competition will be more. So if more businesses are competing, that means the prices will be reducing, and businesses will do their best to give the best quality for customers. And of course, as I said, businesses will become large, and in the future they will benefit the country. So when Apple started, or when Google started, or when Virgin started, they were small, and when they become big, they are main businesses, let's say, in the economy. So in the States now, these businesses, of course, they benefit the economy, and they hire thousands of people. So that's why the government will support these businesses. Now, how the government will support them, it depends on the country actually, but usually the governments will give these businesses low interest loans. So usually they give you a loan, for example, for 3-4 years, and you return back the money with low interest. Sometimes governments will pass their own regulations to lower tax rates on your profits, especially if you are a new business, and this will happen for 2 or 3 years from the beginning, so to help you use your profit to grow. And in the States and Canada, as I know, they provide free trainings for workers, so they have their own centers for information and advice and the training. So they train you how to manage the business, how to manage workers, and many more things. Remember, the target is to help you grow and help your business to succeed, especially at the beginning. Now, measuring business size, which is the second topic in the syllabus. Measuring business size is really important. When I say business size, I'm talking about the size of the business, which can be measured by several things. So sometimes firms can be owned and run by single individuals. Some businesses, they employ hundreds of people, or hundreds of thousands of workers all over the world. So it's important to know how should I measure the size of the business. So first thing, who is interested in comparing business size? So who will look at the business size? These people here are those who are interested. So the first one, or the first party, let's say, are investors. These people, they want to know the business size before deciding which business to put their savings into. And governments also are interested to know the business size because, different tax rates will be there for small and large businesses. Competitors also, they want to know the business size because they want to compare their importance to other firms. Workers, for example, also they want to know the business size because they want to know, for example, for whom should they work. And banks, of course, they want to know the business size because they want to see how important a loan is to the business, and they want to see the business size to decide if they give a loan to the business or not. So broadly, the business size is important for these people, and measuring it can be done by several ways. So when I say measuring the business size, the first thing, or the first factor, let's say, is the capital employed. Capital employed is the total value of capital that is used in the business. So when I say capital employed, I can look at the capital employed of the business, and I can see if the capital employed of the business is high or low, so I can tell if the business size is big or small. But always remember the limitation, because in many industries, when I say capital employed, for example, in a business like cars industry, their capital is very high, However, in other businesses, the capital might be small because the nature of the business. But maybe the business, other businesses, let's say computer design or computer software design business, might have a bigger size than the car manufacturing business, let's say. So capital employed has this limitation. The other factor we consider is the value of output. The value of output is also a common way of comparing the business size, especially in manufacturing industries. Value of output, I mean the value of sales. Also, we have a limitation here because it also depends on the industry, because some businesses, if I'm talking about cars, the value of sales will be higher than any other business, which is, for example, supermarket, let's say, or hypermarkets. But again, I cannot rely only on the value of sales to say this business is bigger than other business. The third one, which is important to know, which is number of employees. Number of employees, the people employed in the business. This is an important factor to consider when I measure the business size, but the limitation is really important. And I saw questions about this in past papers. Remember, some businesses, they use machines, they use equipments, and they don't use workers. So for example, BMW factory, they use robots, and they hire 10 or 15 workers only. So we call them capital intensive businesses. These businesses, they rely on machines and equipment. However, other businesses are labor intensive businesses because they hire a lot of people. They rely on workers. They don't rely on automation and computer controlled equipment. So now if I want to see the two businesses, I cannot say this business is bigger because they have more employees. What if this business is very big but they rely on machines and equipment? So it's misleading to say or to measure the size relying on number of employees. The last one, which is market share. When I say market share, it's the total value of the business sales out of the total sales on the market. So for example, when I say market share, let's say I have two businesses. A business might have 10% of the market, and this market is, let's say, selling grocery or selling sweets, for example. And I have another business which is cars, and the business owns 3% of the market. So now you'll say at the beginning, okay, 10% is more than 3. And this is probably wrong, because I have to look at the total market value first. So if I see, for example, the total value of selling sweets, or the market value of selling sweets is $500,000, let's say. So 10% of $500,000. And B, for example, the other business, which is cars, they have like 6% of $8,500,000. So now, of course, B is bigger because the market value is bigger. So how to know it? The market share has a rule. You'll study this later, but just know this. Usually, if you want to know your market share, you have to divide your sales over the total sales of the market. So let's say my sales are 20,000 and the value of sales in the market 100,000. So 20,000 over 100,000 will give me the market share. Okay, so all these should be used to measure the size of the business. I cannot rely on the capital employed, or value of output, or number of employees, or market share alone. I should consider all these to find out the size of the business. And remember this point, because students usually answer in the exam and they say measuring the business size will be profit, and this is totally wrong, because small businesses sometimes make profits more than businesses bigger. than them. So it's not a factor to consider when I measure the size of the business. You can say profit is measuring the business success. This is true, but measuring the business size, no, it's not an acceptable measure of business size. Remember this, because this is really important. Don't ever say profit is a way of measuring the business size. Okay, so this is for measuring the business size, and this is just a summary. So as I said, useful for investors, governments, banks, workers, and competitors, and we have a lot of methods to measure the business size, and now we know the limitations of measuring the business size. Okay, so now we covered two topics. We have a simple questions they also ask about in the exam. Reasons why businesses usually expand their businesses. It's clear, of course, businesses, they want to increase their market share and the profits, and they want to make more control over the market. But we have to study how they do this, how the business grow. Businesses usually grow in different ways. So the first way, which we call internal growth. Internal growth, it's when business expands its own operations, its existing operations. Usually they do this by developing new products, by finding new markets, for example, or they try to increase the number of goods they produce. So as you can see here, the business is relying on its own operations. So let's say a restaurant owner could open other restaurants in other towns, use the profits to buy new machines, expand his products, and so on. All these are internal growth. However, internal growth, of course, it's a slow because it takes time to expand using their own profits. That's why some businesses, they decide to go to the external growth. When I say external growth, it's when the business takes over or merges with another business, and this is what we call in business integration. Integration, when a firm is integrated into another one. External growth is or can be done by merging with another business. So A plus B will be AB, for example, or taking over another business when you buy more than 50% of another business, or you buy out. Buying out is totally purchasing other businesses. So A will buy B, and now A owns the company. In this chapter, they talk about the different ways of integration. It's very important to understand the ways of integration, and you understand the benefits of each one. Okay, so we'll start with the first type of merger. We call it horizontal integration. Remember, integration means merging. So when I say horizontal integration, it's simple to understand. Why? Because when I say integration, I mean merging a business with another business. Okay, so as you know, some businesses, they are on the same level of production and industry. Let's say a bakery merged with another bakery. So the bakery is on the same level and the same stage of production with another bakery. So when they merge, we call this horizontal. So it's a bakery and this is a bakery. They are on the same stage, and these businesses are similar. So when they merge, we call it a horizontal integration. So it's simply when a firm buys another firm in the same industry and the same stage of production. Of course, the benefits will be that the number of competitors will reduce and the business will have a large market share. Of course, a lot of businesses, they do this. They decide to merge together to have a market share bigger than the competitors. This is for horizontal integration. This is a simple example here. We have a lot of examples of horizontal integration. Any two businesses in the same level of production, they can merge together For example, tractor manufacturer with another tractor manufacturer. When they merge, this is horizontal integration. Okay, then in the vertical integration, when I say vertical integration, it's when two businesses merge together, but these businesses are on different stages. So when I say vertical, of course businesses are not on the same line. I mean they are on different stages. So let's take an example in horizontal on vertical integration. Let's say a potato factory or a potato farm and a chips factory, they decided to merge. So the potato farm is on the primary sector level, you know, and the farm on the primary sector and the factory is on the secondary sector. They are on the same industry, yes, they are. They are on the same stages, no. They are totally in different stages. So when a business like a potato factory decides to merge with a business like a farm, we call this vertical integration. In vertical integration, I have two types. The first one is called forward integration. Forward integration is simple. I'll explain it in this way. So this is a potato farm. Okay, this is the farm, and this is the factory here. Okay, so when this farm decides to merge with this factory, we call it a forward integration. Why forward? Because the farm is in the primary and the factory is the secondary. So a farm is deciding to merge with the factory. So this is a forward integration. Or maybe a factory will decide to merge with a seller of chips. So also this is forward integration. Forward integration is when a business takes over another business that comes after in the chain of production. Don't memorize the benefits, just understand them because they are totally clear. So imagine you are an owner of the farm and you decided to merge with a factory. So of course you will you'll make sure that your products will go immediately to the factory. The factory will buy them, and of course the factory will be able to produce the goods and sell them. And of course we can say the retailer could be prevented from selling competitors' products. So this factory will not produce other products, will not take potato from other farms, you will take only from your farm. So this is the main benefit in forward vertical integration. The other one in vertical integration, which is the backward vertical integration. Backward vertical integration, it's when a business takes over another business that comes before it in the chain of production. So when the factory now decides to merge with the farm, I say this is a backward vertical integration. Or when a seller of furniture decides to merge with the manufacturer of furniture, we say this is backward, also vertical integration. So also it's simple to understand. If you are a seller and you merge with a factory of furniture, you are a seller of furniture, decide to merge with a factory of furniture, of course you will have assured supply of important components. You'll know that there is a supplier who always supplied you with the goods that you need, and of course you can have the best control over the components and supplies from your manufacturer. Okay, just understand them, and don't memorize the benefits, just understand them, because they don't ask directly about the benefits of integrations. They just want you to know that external growth is totally different from the internal one. Okay, the last one, which is in integration, we call it conglomerate integration. This is very simple. It's where two businesses, totally different stages, totally different industries, they decide to merge. So if I am an owner of, let's say, a potato farm, I have a business and I decided to merge with the business which sells, let's say, clothes. We are totally different, but we decided to pool our money together and merge. And this usually happens a lot in business. Businesses usually they decide to integrate, and maybe they are completely different in the market. So like this example here, Walker, for example, the crisps with Next, which is a clothes store. So here the business will have more diversified activities. You know, I have a lot of activities that I can put my money in, and I'm spreading the risk now. Instead of taking the risk alone, other people are taking the risk with me. So in integration, I have two types. Remember, in growth, I have two types, internal and external. So internal is when you use your own profits to expand. It's slow and it takes time. However, when I decide to merge externally, I will merge with other businesses. So usually it's faster than relying on my own profits to expand and produce more products and expand to new markets. Now the last point on this topic, the problems that are linked to the business growth. Remember, we have a lot of problems, and we have a lot of possible ways to overcome the problems. Also they are easy to understand. So when I say, for example, large business, because of expansion the business will be large. Of course it will be difficult to control. So usually the solution is to have small units and try to divide your business into small units. Sometimes large business, they have poor communication, and this happens a lot, and this is the main reason of failure in business. That's why nowadays businesses use IT solutions and telecommunications to avoid the poor communication between them. Let's say we have also expansion costs. We have sometimes different management styles. So if two businesses sometimes merge with each other, managers are different, their management styles are different, you know, there will be a clash between them. So you should, as a solution, you should have a very good communication with your workforce, and you have to make everyone understand the reason of this change. So you'll face a lot of problems in case of expansion, but you have a lot of ways to overcome the problem. Okay. Last point here, the reasons of business failure, and why the businesses remain small and the reasons of business failure. These are two small topics at the end of the syllabus. So the reasons of businesses remaining small are many. The first one is owner's choice. Some business owners, they want to be small. They don't like to take risk, and they don't like their business to be big. So they decide they prefer their firm to be small. Or maybe the market size is already small. Let's say if you are a hairdresser, your market size is already small. You cannot expand. You cannot be in the same place at the same and more than one place at the same time. So your market size is like this. So it's simple. You cannot expand. Maybe the finance, which is the main thing. If your finance is not enough to expand, probably you will not be able to expand, and you will remain small. And the fourth one, which is market domination. Some businesses, they dominate the market. They don't allow you to expand in the market. Or some businesses, they make it difficult for you to compete. You cannot compete with big businesses already in the market. So that's why you decide to remain small, because you cannot expand and become bigger. This is it for this question. And this question is not the main thing in the syllabus, and there's no direct questions related to it. But you should know why businesses decide to be small. Always concentrate on this in the exam. This is an easy factor to remember. Lack of finance is what makes my business remain small, for example. Okay, the last point, which is business failure. A lot of details are in the book. But when they ask you why some businesses fail, of course, not all businesses are successful. Remember, the rate of failure for newly formed businesses is very high. Sometimes it's over 50% in some countries. When I say newly formed businesses, I mean businesses operating and their first 3 4 years are the hardest, let's say. So even old established businesses or firms can close down because they make losses or they run out of cash. So a lot of reasons why businesses fail. The main one, of course, poor planning, and as I said at the beginning, the business plan is really important, and the importance of objectives also is clear. Location decisions, poor location decisions also is the main reason. Competition, a lack of finance, of course. Poor management. Poor management is really important. This is what makes your business fail. And poor cash management is even more important. Cash management is how to deal with your money. Maybe the business might have millions, but if they don't have a good plan how to use the cash, of course, they will fail. And sometimes some businesses, they fail because of economic influences. When I say economic influences, I'm talking about disasters, government new rules, and many more. So these are the economic influences. We call them the external influences. So the business probably will fail for this reason. Okay, so this chapter was long, I know, but it's really important to understand it. I hope I covered all the topics in the syllabus, and now you understand all the topics. Hopefully we'll solve past papers on these chapters that I already covered, 1, 2, and 3. I'll try to solve past papers with you and tell you how to start solving paper 1 and paper 2. That's it for now. Thank you for listening, and please, if you have any questions, you can always ask and comment on this video. Thank you, and see you in chapter 4.